Okay, so moving on to the next kind of subtopic of data analytics is looking at how it'll impact users. And so specifically, I'm talking about users of financial statements. So we have our investors, which could be shareholders, right? They're trying to analyze information. Chances are, if you're talking about doing data analytics, it's a sophisticated shareholder. It's not just someone who has, some kind of pricing strategy where they're just looking at momentum, for example, in prices and trying to trade on momentum or something like that. These would be individuals that would be trying to process the financial statement data in a much more sophisticated way, possibly using things like XBRL, right? Analysts would definitely be a sophisticated set of users that would want to um, use as much data as they can get their hands on, right, to be inputs into their forecasting models, whether it's earnings forecasting or trying to forecast whether to buy, sell, or hold. Um, and so they would be another group that would use more information. Short sellers, and if you don't know what short sellers are, those are essentially investors that are taking the downside of the proposition of the stock, where the stock's going to go. So they basically are betting against the firm. They think that the share price is about to go down significantly, and so they short the stock um, in a sense, with basically banking on it going down, probably due to some bad news they think is going to come out, or possibly because they think it's overvalued, right? And then debt holders will be another group, um, especially banks and such that might use more data analytic approach to trying to estimate risk, for example, for a given firm prior to actually loaning or giving a loan, or possibly after they've given a loan, trying to estimate what's the likelihood they're going to run into a default. And so those are users, those are investors essentially that would um, use more data analytic information. And again, XBRL would be one of the tools where you can get more information than what you typically can get, or it's in a format that is more easily read into a given model. So in the past, there were aggregators of information like Yahoo Finance and Google Finance and some of these aggregators, but they were very spotty in terms of filling in information for a given firm. There would be large financial statement items that would just be left blank because they didn't quite understand how to take published financial statement data and then put it into their kind of template. Whereas XBRL says everybody has to put it into the same template. Now, granted, there are different templates for different industries, but given that you know what the template is, and you can get the data that is filed electronically with for these publicly traded companies, and a lot of these sophisticated users. I mean, you can find pretty easy tools, free tools, for viewing XBRL information from firms. Now, the more you want to do with it, obviously, the more sophisticated the tool needs to be, and so that's where you get, the analysts and the short sellers and even debt holders, for example, that have these custom-built tools that extract information and then process it to basically fit into the models that they have created. There's also tools around text parsing. So, for example, I've used Perl before to try and parse, kind of extract text from lots of the filings all in one sitting. Or Python, I've also recently been using to extract information from like 8Ks, for example, or from the 10Ks. You can extract information that in the past would have been hard for you to go out and manually collect, right? So there's tools out there for these users to have a more data focused approach to all the decisions they have to make. Now, when you look at regulators also are going to be using more analytics, right? So the SEC has an accounting quality model called RoboCop, and that's his nickname. And so it has an automated system that once the filings are submitted, it can go through and identify high-risk filings in a very short amount of time, right? And so it also uses XBRL data, and I think it even does some text parsing as well, so it's not just relying on the XBRL data. but lots and lots of things are tagged using XBRL tags, and then the SEC can look for um, certain relationships. It can look for unexpected changes. It can basically come up with this risk score to say what's the risk that there's a material misstatement in these filings, right? And then based on that risk score, the SEC can allocate its time for its inspection staff to focus on those high risk financial statements that have been filed, right? And so it can make the regulators more effective and efficient as well, not just the firms and the users. So then, big picture, let's think about audit analytics, because that's what, at the end of the day, that's what we want to focus on. So how do you define audit analytics? There's a couple different definitions out there. The AICPA has one. It's the science and art of discovering and analyzing patterns, identifying anomalies, and extracting other useful information and data underlying or related to the subject matter of an audit. And you can do it for the purpose of planning or performing the actual audit. And so audit data analytics, that's the ADA, is essentially audit procedures used to discover and analyze these patterns, right? And get this information. So the big advantage for analytics, and I've mentioned this before, but this is a huge advantage, that it can basically test 100% of the population, right? Whereas historical substantive testing has basically looked at samples, so there may be 1,000 invoices, but the sample looks at 50 invoices or 100 invoices, right? And then tries to do some manual test. Whereas with audit data analytics, you basically program the test and use the data that the firm has in order to test all the transactions. Okay, and so because of that, you have a much bigger scope of what you can test, and you can test things at a more precise level than you could in the past. Right, so it can be used in any phase, but the dominant area that it's used for is for test of controls and substantive testing. Okay, so test of controls, for example, would be, let's say there's supposed to be a authorization for a purchase order, and it's supposed to be a certain set of individuals, right? So as long as the system, when it records, it has a workflow where somebody initiates a purchase requisition, someone else has to authorize it, and then when they authorize it through the system records who authorized it and when. Well, as long as that data is being stored in a table someplace, in a database, we can extract that data, look at all those transactions, and then ask the question, are there any transactions, any purchase orders that don't have an authorization? And then we can do another test and say, okay, for the authorizations, is it the people we expect to do authorizations based on who the client has told me were the individuals that were authorized to do that approval? Okay, so that's a good example of a test of control, and I can test all of the purchase orders, and I have to take a sample, right? Substantive testing is where you would look at like a test of transactions. So, for example, you have invoices that you're going to bill your customers with. So you're creating the client is creating an invoice for their customers, and so you have the detailed data around the items that were shipped, or the items on the invoice, when they were shipped, and prices and quantities, right? And then there's an extended amount. So one substantive test could be to make sure that they calculated the extended amount correctly. And so you take the quantity, you multiply it times the price, you come up with what you think the extended price should be, and compare it to what the data shows that they billed them for, right? And so that would be an example of a substantive test where we're looking at accuracy. And so again, I can do that, I can program that using some special software, and then once I do, so the example would be like ACL or IDEA, that's audit software, and then once I do, I can find any differences and then investigate those differences, right? Now the risk for data analytics is that the data they give me as the auditor, so the data that my client gives to me as the auditor, has been tampered with sometime between when it was in the system and then when they give it to me, right? And so I need to get some assurance around the general controls around who has access to the data, um, who is going to do the extraction, are they authorized to do the extraction, could they have possibly manipulated anything, and so I'll have to get some comfort around that to make sure that the data that I get is and matches the data that's in the database, right? And there's ways to do that. There's ways to do those tests, but that's going to be the big risk there. So I already mentioned those audit software that's out there. Other technology tools, Power BI, Tableau, and Tableau Prep. I think you've used some. You maybe have had some of you may have had experience with Tableau before. Alteryx is another one, and Alteryx even has kind of a way that it can integrate with Tableau, especially Tableau Prep. And so, these tools are out there now to help with audits, and more tools are going to be used over time and created over time. So, these lists aren't static; they're going to be dynamic. They're going to be changing over time. So you got to be careful not to get locked into one particular tool, but just recognize some tools have advantages and disadvantages that you have to compare. And again, it's going to be based on what you need as to which tool that your company might decide to use, for example, as to which tool is appropriate. So some additional examples. I gave you a couple already. So three-way match procedure. You want to make sure, right? Remember, the three-way match is: does the purchase order line up with the receiving report? Because the client ordered inventory, then they received it in. They got the receiving report was created, and then they got an invoice, and this time it's from the vendor. And so, do all three of those line up, right? Do the amounts that were received on the receiving report match the amounts billed on the invoice? Does the price put on the purchase order match the price on the invoice? And then that's the three-way match. So I'm making sure that those three are lining up, right? So that's a control that our client should do, but the auditor could re-perform that control to make sure that the same results are found. And so if they say, yeah, all of our purchase order or all of our accounts payable has gone through the three-way match, well, we could check to make sure that there aren't any accounts payable where that three-way match didn't line up, right? And so that's an example of another piece of data analysis. Segregation of duties would be another one where we might look, we could get a table with all of the users in SAP, for example, all of their roles that they're assigned, and then through a program we can look to see, are there any incompatible roles that are assigned to the same person, right? And so we could do that with a program much easier than we could if we had to search through every single user, or if we had to search through even a sample, because the risk would be that sample did not represent the population. But again, if we can get the entire table of users and the roles that were assigned to the user and the privileges that were assigned to the roles, then we can do this programmatically much faster and much more efficiently to evaluate segregation of duties problem, or see if there's a potential segregation of duties problem. So if data is what we want to use, how can we make this more efficient? And so the AICPA has been thinking about this, other stakeholders have been thinking about this. And so imagine we have the situation, we have 3 clients and 3 auditors, right? And so it's fine, right, if that's the stable situation we have, because after the first year, you're kind of learning about the client and learning how their information is set up. Then you can kind of apply that going forward. But the reality is that sometimes we get changes, right, in auditors and who their clients are. It's now the auditor has to relearn exactly what how the client's account information system is set up. The client has to relearn what kind of information the auditor wants, and so that can potentially lead to inefficiencies, right? So the AICPA said, hey, what if we came up with a set of standards that were focused on how data should be laid out in terms of information or data that's transferred from the client to the auditor. And so the goal is to create a common set of standards that both the clients and the auditors both understand and use the same set of standards for the data in terms of how it's arranged, its format, all those things. Okay, and so there are different modules out there at this point: general ledger, order to cash, procure to pay. There may be others too, but at this here we can see an example. Here's a general ledger, what the general ledger looks like, and essentially all these rectangles represent different tables, right? And so there'd be more detail in for each of these tables. It would say, right, for the GL detail, here's exactly all of the data elements that we would expect to see in that table. The chart accounts, there would be more detail around exactly how the expectation is that chart of accounts be laid out. So all these items would be filled in. And so when the auditor asks the client for the general ledger data, then the client would just use this AICPA standard to then deliver data in this format, right? And so even some of the ERP systems, for example, right, probably the best way that this will get implemented is if they kind of pre-program some modules that can basically take the client's underlying data from the database, populate it into this format, right, get the information into tables that look exactly like this, and then it'll be easy once an auditor requests it, because this will be something that would have already been programmed and would be an easy way for the data to be extracted and given to the auditor. And then the nice thing is, doesn't matter how often you change, right? Doesn't matter which client works with which auditor. The goal would be that once the client initially goes through that process to set up how to map their data onto the AICPA standards, then it doesn't matter which auditor they use, right? And so it makes it more efficient to potentially switch, which is usually a good thing, because that can be a restraint on bad auditing, and it can also be a restraint on keeping around bad clients, right? If there's cost to switching, so it helps reduce some of those costs, which can actually result in a more efficient process for the audit. Okay, and so that's the goal. Don't worry about memorizing all the details of this. Just recognize this is generally what this process looks like. There's an order to cash process, more tables, but still something that could easily be, or not easily, but relatively straightforward for the companies to program their data to be extracted and create a set of tables that match this. And then that way, you can look at the procure to pay. That way the information can be used by the auditors, and they can start developing more sophisticated ways to test using this format, because they don't have to worry, oh, wait a minute, how does this company have their information set up, right? They've already got it now in a more standardized format. So they can spend their time as auditors figuring out how can we extract more information from the data that we've been given.